Hello, today I will present about financial analysis of bus manufacturer. And this is financial statement of bus manufacturer. Firstly, profitability and efficiencies of bus manufacturer. Profitability is classified four main sectors and efficiency classified five main sectors. And, and each ratio will indicate the efficiency of the companies in different segments. Firstly, in its return on equity ratio. It measures the rate of return on company stocks held by shareholder. From that, the investor will consider to evaluate how good the company is in generating profit from investment by stock. And the profitability from investment of bus manufacturer was good in the beginning and keep going to the next year, but in 2014 to 2015, it's reduced same as industrial ratio. Next one is return on total assets. Is a bit similar with return on equities. However, this one is measured based on the total assets instead of the stock of the companies. First year, the return ratio was excellent and it went down gradually to a level below industry ratio. And next one is net margin ratio, used to calculate how much the rate of the profit after tax from each dollar of revenues. If compared with the industrial rate, this rate is not only average, but also deeply declined to 0.105 until 2015. And gross margin ratio measure the proposal profit after subtracting the cost of goods sold, although the net profit margin ratio in the first year is the highest. Gross margin ratio is the lowest compared to the rest of the years, and the industry ratio by 40%. So after analyzing the above four sectors, I acknowledge that the profitability but companies decline year by year and there's no sign of recovery. And the next one is efficiency of companies. Fixed asset turnover ratios is an efficiency ratio that calculates the efficiency of companies' machinery and equipment. See that figure, but companies operate very well in two first year and go down slightly in the end of the 2014. And the next one is receivable days and receivable turnover ratio. Both measure the efficiency of companies on collecting receivable and the credit to customer in terms of debt collection ability. The company started off badly and it got worse in the following years, with a peak at 91 days. It's twice the industry average, and the receivable turnover ratio does not get any better. And the next one, inventory days and inventory turnover ratio. Both measure the efficiencies of the companies in inventory control, as you can see in inventory turnover ratio chart. But manufacturer improved from 3.8 to 4.8, but it dropped to the bottom at 2.5 after that. And another chart is even worse because the line only went to negative way to and reach to peak at 142 days, which is double the industry rate. In totally, according to the ratio analysis before, but operate efficiently and have a lot of difficulty in managing products in stock and processing with unpaid invoices from customers. As an analyst at financial analyst, I suggest that BAT should concentrate on 4 areas. The first one is working capital turnover ratios. It's only half of industry. It shows that disbursement ability of companies is not good enough, lead to production chains will be broken. Besides, interest coverage ratio also should be focused to attract investors because it calculate how risky it will be to invest in companies. And the next one is receivable days and inventory days. They clearly reflect the efficiency of the company's management about debt collection and stock control. As you can see, in the third year, credit sale of companies is extremely high, lead to increasing the cost of goods sold. But the total sales dropped deeply. The last one, and the last but not least, is the inventory days. Initially, but control. So initially, BAT's control of merchandise were slightly above our industrial average, and it was stricter by the end of 2014. That is the reason why the cost of goods sold in 2014 only increased 4 times, but inventories increased 7 times. And finally, which BAT companies are not looking forward to responding to? It is borrowing money issues. As the lender as well as the bank, I will give BAT 4 arguments before making my decisions. Firstly, the current ratio of companies were 1.6 and trend close to critical level that the business was not able to pay its debt, so it should be considered a risk. In last year, the excess test ratio is under 1:1. It means that the amount of current liability is much more than the amount of current assets. So the company is no longer able to pay interest. The next is the company's interest coverage ratios is showing signs of an unstoppable decline and lead to the companies will go into recessions. And negative indicators analysis about profitability and efficiency above indicate that BAT operate inefficiently and severely reducing its profitability. Therefore, I will reject BAT manufacturer requests. So nevertheless, BAT also have its own trend, such as potential human resources and abundant capital. They are two of the factors that help BAT maintain from 2012 and 2015. Moreover, to take advantage from potential pictorial market to employ in footwear market, but manufacturer need to overcome the weakness such as collecting debt from customer and inventory management, but must balance between selling products on credit to customer and paying supplier. And the last one, I highly recommend that BAT should recalculate that BAT should calculate incoming and outgoing goods for better inventory management. And there is reference I support me to present this financial analysis. So thank you to listening.